And so I'm going to reinforce these messages throughout the presentation. It's going to be a bit repetitive, but I really think that's necessary because I'm hoping that you all can learn from some of my mistakes and just learn some of the key lessons to get started investing. Okay, some definitions before we jump into the content. I'm going to talk about indexes or ETFs. So these are exchange traded funds or indexes that track specific benchmarks. And there's an index for anything that you can think of. Really anything, retail companies, raw materials, electric vehicles. However, there's three major indexes. So these are the ones highlighted there. You've got the Dow Jones, that's the 30 largest companies in the US, the S&P, which is the 500 largest US public companies, and the NASDAQ, which is the technology index. When people refer to the market, they're typically referring to the S&P. And then I'm going to talk about robo advisors, which is also a robotic advisor. And it's a digital platform that allows you to automate your investing. So when you log into one of these, it asks you what your risk tolerance is, what your goals are, and then it creates an investment plan for you and it automates everything. So it's a really effective way to get started if you're unfamiliar with this space. And I'll mention CAGR, or compound annual growth rate. Another way of saying this is the average annual return. And this is a way to compare different investment opportunities against one another. So something might have a target return of 20% annually, and something like treasuries at this point will have a target return of 5% annually. And so it's a way to assess risk. The higher the expected return, the more risk you're taking and the more volatility you'll have. And then finally, retail investors. This refers to people that are non-institutional, just regular people like us. Okay, so rather than burying the lead, I'm just going to share the learnings with you all up front, and then the rest of the presentation will reinforce this. So, and also there's a lot of text on these slides. It's meant to be a take-home presentation, so you can go back and refer to this. I understand it's not the most appealing presentation. So invest as much as you can on a regular schedule into index funds or robo-advisors. That's the key point, the key takeaway for this entire presentation. And in action here is just take a certain percentage out of your paycheck each month, have it automatically go into your designed investment strategy. Keep it simple. Don't reinvent the wheel. A lot of people have tried a lot of different things over the years, and over time, indexes typically beat the most sophisticated investors, and I'll have some data in the presentation that proves this point. Don't get overly concentrated in one investment strategy or one stock. You can obviously make outsized returns in this case, but also it's a really good way to get hurt and damage your financial future.
Sure, I'll have some coffee. Jose has not eaten lunch.
Everyone, please put on mute if you're not already on mute.
And then avoid a similar point. Avoid trying to get outsized returns or home runs. Live below your means and have a sound budget. And you want to come up with a plan and stick to it, but always be flexible. And I've got a lot of stories about this, but one key story that I think of is BlackBerry. They used to dominate the smartphone market. This was prior to Apple even having a smartphone. And so, if all of your money was concentrated in BlackBerry, you might have thought to yourself, well, like no one's ever gonna dethrone these guys. It's everybody in the business world is using it. And here we are, 15 years later, and BlackBerry hardly exists anymore. And they're definitely have barely any or zero market share in the smartphone market. Okay. So this is something an exercise you all can do after the presentation if you haven't done this already, but you want to get clarity on these questions, and you want to do some goal setting. And so, I've highlighted here, but just think about what are your personal goals, and then what are your investment goals? And there's some key things that may be coming up in life that can determine this. Maybe you want to buy a house and you'll need a down payment for that house, or maybe you want to quit your job and start a company. You want to understand how much money you have and how much cash you need. So one rule of thumb is you always want to have some spare cash. People have different rule of thumbs here, but maybe 3 to 6 months of cash on the sidelines for life expenses and you don't want to have that invested into risky investment opportunities. And then back to one of the points already mentioned, figure out your annual budget, make sure your lifestyle is within your means. And if it's not, figure out how to get there. You always want a rainy day fund for the unexpected or for opportunities. And then once you've answered these questions, you can construct your portfolio. You can come up with an investment strategy and then, construct your portfolio and invest on a regular schedule. Okay, here's an example.
Irvin, can you go on mute real quick, just because there's a little background noise?
Here's an example of how I went through this exercise. So I just started with the very high level. I want to live a life of joy and happiness. I want more free time, and I want to take care of my health. In terms of investment, I have a target. I want to earn 6 to 8% annually. So treasuries, which is the risk-free rate, you can look at the U.S. treasuries. That's backed by the U.S. government. They're delivering. Some of them are delivering around a 5% return right now. So I need to take on a little more risk to get to that 6 to 8% annually. Now, if I had different goals and I wanted to earn 20% annually, I'd have to take on way more risk and deal with more volatility. So just know what your goals are. And if you have a longer time horizon or you're really young, you can accept more volatility and you can deal with the ups and downs of the market. Good question, Sarah. Thanks for that. So Sarah asked, how did I come up with 6 to 8%? And that's just based on how much money I have and how much I'm hoping to grow my investment account. When I was younger, I was taking on more risk in trying to earn more. And then I also invest in some different asset classes that are more illiquid. Stocks are completely liquid. So if you own Apple stock, you can go into your account right now and you can sell shares. There's always demand for that. Whereas if you're investing in something private, it's illiquid, and it takes a lot more effort to get rid of that asset to sell it. So I have some illiquid investments where I try and gain more than what I'm gaining in the stock market. So Max mentioned that he didn't want to lose all of his money in crypto. This next point, preservation of capital, is the most important. You want to avoid unnecessary drawdowns, because if it's really hard to earn money, as we all know. And if you've saved up, 20K or 50K or whatever that number is, you want to avoid having a huge drawdown. So if you put all 50K in Bitcoin when it's at 60,000 and it drops down to 20,000, you've lost 60% of your money. So you want to avoid that. Next, same on the next bullet, don't take unnecessary risk. If you don't understand what someone's talking about, just don't invest. And if you still feel the desire, like you have too much FOMO, make it super small so that it doesn't stress you out. If you can't sleep at night, your position size is too big. And then keep it really simple and straightforward. And then another goal of mine is to increase my passive income. I do this through private real estate investing. And the goal there is to ultimately build that up larger than my annual budget. I invest on a regular schedule. And then I do love following the markets and the economy. And I'm doing that to continually look for new opportunities. Okay. Things to avoid. This slide is really, really painful for me to look at because it cost me a lot of money to learn these lessons. And I'll go through this really quick. So high fees. There's mutual funds, and some of those might have an expense ratio of like 1.5%, whereas you can find an ETF or an index that tracks the same exact index, and maybe it's 10 basis points. So it's 1/15 the expense ratio of that mutual fund. So just you want to be aware of what the fees are. Exotic investments. There's always a new story. The story right now is AI, and if you read anything about companies or listen to any earnings reports, every single company is going to be talking about AI right now, and that's going to juice their stock price. It may be real, it might not be. 2 years ago, it was all crypto, Web3, blockchain. Some crypto punks were worth, I don't know, $5 to $10 million, and now there's zero demand for those. So just avoid the sexy story. I mean, there's certain things that are consistent throughout time. Just think about it logically. I'm not recommending any of these stocks, but if you think about Home Depot, or McDonald's or Chipotle. When you walk into those stores, there's a lot of people there. There's demand for those products and services, and you can see, feel, and touch those. Whereas something that's really esoteric or maybe doesn't have utility, it's harder to identify if it's legit or not. So just avoid those trends, and that's the point there. And then I'll show some slides later that show how these indexes typically outperform active managers. And then fictional stories. So this is one that that is really prevalent in the investment world. Everybody's always talking their book. They rarely talk about their losses. And so I would just say, if you ever are talking to someone, ask them, hey, tell me a story about something you invested in that didn't go well. Tell me about something that went horribly wrong. Like, you want to hear some humility, and you want to hear the truth. When I was younger, I used to hear people always talking up their book and talking about the times they had a 10x on an investment. Well, if they told you they invested in Tesla in 2012 and have held it all along, maybe they did. But if they took that much risk, they also had a number of companies that didn't work out. And there's a survivorship bias within this industry where, I mean, even if you just go online and you look at these financial articles, a lot of them say, oh, this is the next Amazon. Well, for the next Amazon, for every one Amazon, there's like 100 companies that failed. And it's also true in the crypto world or AI or Web3. So just be aware of that. You don't want to take on too much risk. Don't put all of your eggs in one basket. Your friend might have an incredible startup. Don't put 25% of your net worth in that company. You want to keep about you want to limit your position size to a certain percentage. That can be different for everyone. My recommendation here is just put all of your money into indexes. Don't even worry about individual stocks. And Valerie just asked, what about day trading? So this next point, market timing, I would say never day trade. It's a loser's game, and you might have some early wins that make you feel like you're smart, but ultimately you're going to get burned. I'll show some other slides supporting this as well. So market timing is impossible. No one has any idea. Stock tips. Someone might have deep industry knowledge, and I'll just give you guys a quick example. I follow this person who knows more about chips than anyone else I've ever met. He knows more than anyone on TV, and he said that NVIDIA was overvalued at 200. Well, NVIDIA went from 200 in a straight line to like 480. Actually, I think it initially went to like 430 or something. Then it went from 430 down to 130. And then it went from 130 back up to 480. So, the market is, it's driven by momentum, sentiment, and narratives. And so you just don't know. I mean, maybe the true value of NVIDIA is 200, but if it gains some momentum, it plays into that AI narrative, and it's going to be, then people are like, well, this is the most important company in the world. And then it becomes a $1 trillion valuation. You just don't know. You don't know what's going to happen. So just avoid stock tips. And also, people have different goals and agendas. Maybe they're going to hold it for a month. And if you don't follow the market that quickly, you're going to be stuck with one of those stocks that totally collapses. And, it's kind of similar to Jay's question. He asked if stocks you invested in during COVID are down 75% or more. Do you favor cutting losses on what's left to put in an index or ride the volatility wave? That's dependent on each company that you're invested in. That story's really consistent across many, many different stocks. You mentioned Zoom, but it's also Etsy. Peloton's down like 90%. When Peloton's at like less than $10 right now, is at 170. And when it was at 170, people said Peloton is the next Apple. It's an incredible hardware company. They're going to become an apparel company. They're expanding to different product lines. And so people create a narrative to try and understand why a stock is up so much. So, it's dependent on the company. For something like Peloton, I don't know. I don't follow any of these that closely, but I think some of these will come back, but a lot of them are just going to be like, if they're unprofitable companies, they're going to really struggle for a long time. And I've got a list of 25 companies. I invested in most of those during COVID and felt pretty smart at one time. And a lot of them are down 50 to 80%. And yeah, I've sold most of them, taken my losses, and put them into indexes. And then finally, similar point, don't listen to talking heads, economists. There's this like meme out there about Jim Cramer, and whatever Jim Cramer says, people do the opposite. I mean, this guy is very smart. He knows a lot about how markets work, and he still gets it wrong most of the time. So don't listen to people and stick to these strategies, and you'll be just fine. Okay, so here's a secret of the investing world. Low cost indexes typically beat active managers. The historical returns are 7 to 8% historically. And yeah, to Mahi's question about the S&P, I mean, that's kind of what I think. You know, when the market crashes, you want to invest more in these indexes, but you want to invest on a regular schedule. I would just pick one day of the month and have your money automatically go into your index or your robo advisor. And then if if there's something like 2022 or 2008 where the market goes down a lot, accelerate your investment strategy or invest more if you've got cash on the sidelines. So this slide that I wanted to share with you, this purple line represents this ETF called ARK. And ARK was the perfect strategy for COVID. So you can see right here, this downdraft was in March of 2022. And till that time, ARK kind of was consistent with the market. And then their strategy became really in vogue. So the things they owned were Peloton, Square, Etsy, all of these it's like electric helicopter companies, like futuristic technology companies. And during COVID, a lot of money flooded the market. And then you can see right here, it just takes off. So your 13,000 becomes 35,000. Now at this point, the leader of ARK was on CNBC and Bloomberg all the time, and everyone's like, wow, this is the greatest investor of all time. They're beating the market by 3 times. And that's when retail starts seeing, her name's Kathy Wood, starts seeing her all over the place at every conference. She's a genius, and they start flooding into her funds. And then you can see what happens here. It goes down a little bit, and you say to yourself, she's so smart, I'm going to, re-up and put more money in. It bounces up. And then it totally collapses when that strategy goes out of favor. And you can see these other indexes. VOO represents the S&P, QQQ represents the technology index. Slowly over time, they outperform this strategy that looked incredible. So it's, a classic tortoise and the hare story. And my thought is I'd rather get rich or wealthy very, very slowly than suffer what happened here, because, it's anyone can tell you who was in crypto or NFTs. They probably felt really smart and wealthy at one point, and their portfolio likely collapsed in value. So this slide is really fascinating. So Warren Buffett bet a bunch of hedge fund managers that the S&P would outperform them over a 10-year period. And I don't know who the hedge funds were, but there were 5 of them that were selected that or took on this $1 million bet. And initially they outperformed the S&P like the first couple of years, and everyone's like, man, like, why would Warren make this bet? It's ridiculous. So a hedge fund has incredibly smart people at it. Typically, they have the best tools in the world. They have the best data. They have faster trading tools. They have all the research that we don't have access to. And they're likely, talking to experts in the field. And you can see over a 10-year period, the average hedge fund returned 36% with high fees, compared to the S&P, which returned 3 to 4 times the amount of the average hedge fund. And that's real money. So if you've bet your financial future on this, over 10 years, you've underperformed by 80 to 90%. That's a big deal. So, that's really the point of this presentation. It's incredibly hard to market time, to stock pick, to be an active investor. So just put your money into indexes. This reinforces the point. So it's nearly impossible to time the market, and maybe you time it once, but it's going to be really hard to time it twice. And an example of this is before COVID, the market was kind of hit this peak, and some people saw COVID coming from Asia, and they took their money out. Now, when there's a recession or a bear market, there's all this data that says, they typically last 12 to 24 months. I don't know the exact number, but something like that. Or you can think of the great financial crisis in 2008. I think the market maybe bottomed 2 to 3 years later. So when COVID happened, some people took their money out and they're like, the market's gonna go a lot lower. The world's ending. People are stuck in their houses. I think 3 weeks later, the market bottomed and then it completely took off. So if you'd gotten your money out here, you saved a 35% drawdown. But if you didn't get it back in, you missed 180 to 400. So more than doubling your money. So, the lesson here is, and what I'm trying to reinforce is, you're going to experience volatility and drawdowns, but when you do, you want to be adding to the indexes. You don't need to be picking stocks. Maybe you have 1 or 2 or 3 stocks that you really love, or the companies intimately, like Apple or Disney, and those companies, everything gets destroyed in a bear market. And so you can add to those, but I think it's really, really hard. And so I just prefer not selecting any stocks and just adding to my individual indexes. And then further to this point, in December 2022, everyone was talking about the market's going to go higher. So maybe you take all your cash on the sidelines and put it in, and you can see what happened. The market collapsed. And then in December of 2022, at the end of the year, the best economists in the world shared research saying, okay, the S&P is going to go down another 10 or 20%. So don't put any of your money to work. Well, the market was already down. The technology index was down over 30%, and the S&P was down 20 to 25%. And if you listen to them and you try and outsmart the market, then you miss this upswing. So in 2022, the technology index was down 33%. And like I said, at the end of the year, everyone said it's going to go lower, take your money out of the market or don't invest anything you have. And what happened was, year to date, the technology index is up 42%. So this is not selecting any stocks. You didn't take a perspective on Apple. You didn't take a perspective on NVIDIA or Google or Amazon or Tesla. You just put your money into an index that has all of those companies within that index. And, 40% is an absolute massive return. And so that's my recommendation there. So hopefully I've nailed in this point. And then on the right, you can see historical returns. The market typically goes up. So when it goes down, that's an opportunity to add more. And this slide reinforces that point. This is the S&P. That's my target, 6 to 8%. I'm trying to just get market returns. I'm not trying to beat the market. And then you can see over time, I don't know what percent this is, but let's just say 75%, 80% of the time, the blue is up years, the market goes up. And so these down years, to me, are an opportunity to invest. There are examples, this is probably unnecessary, but Japan had a really stagnant economy, I think, for 30 years. So their market went into a massive bubble. So that could happen, if the US starts struggling or the GDP slows enough, the US could struggle for a while, but I'm still believing that the GDP of the US is going to continue to grow. Companies are going to continue to grow. And, companies like Target and Amazon and Apple, they typically grow their revenue, and therefore their valuations grow. And that's why the market grows in value. Okay, back to individual stock selection, and we'll wrap it up here pretty quick and do some Q&A soon. So this is just to show you, if you took a bet on Tesla years ago, this is a 5-year chart, you could be up 1,000%. But, at some point you might say, oh, okay, I think that Tesla is no longer just a car company. They're a battery company. They're an energy company. They're going to be the biggest company in the world. Well, at this point, you might say, okay, I just had, I made a lot of money. I'm going to put the 25K that I have into increase the position size of Tesla. And then you can see in the past year, it went down 17%. At one point, it went from 400 to 100 right here. It actually went higher than this. I don't think I show that, but then it went down to 105 or something. So, if you had put all of your money in there when it was at 300 or 400, you would experience a lot of pain. So, that's where position sizing comes in. And if your position in Tesla grew from 1% of your portfolio to 26%, take some gains off the table, lower your risk, and put that into an index. Okay, this is a robo advisor. This is a screenshot from Wealthfront. I use them, and what happens is when you go in there, I think you put in your age, but you definitely put in your risk tolerance, how long your investment journey is, when do you need money, and then it'll come up with an investment plan for you. And all it's doing is it charges 25 basis points, and it will select a number of index funds. And these are the index funds it selects: the S&P 500, the NASDAQ, Total World Market Index, to get you some international exposure. And then you'll have a little bit of emerging markets, you'll have some fixed income, and you'll have some cash. I've tried Wealthfront, Betterment, and Schwab. I think they're all adequate. And if you don't want to do anything, this is a great solution. But if you're comfortable opening up a Schwab account or Fidelity or whatever, and buying indexes or just doing an auto buy of an index each month, you can do that as well.